So a lot of people fear kind of timing the real estate market poorly. I think we're all sensitive to it if we're familiar with what happened in 2008, 2009. I know I grew up in a time where a lot of my friends, family, and parents of friends and family were went through a lot at that time. So I think we all have a little bit of like trauma from the 2008 recession. That was a real estate recession. Um, but the reality is like unless you are friends with Jerome Powell or Joe Biden, or you really have your hands in big decision making at the global kind of macroeconomic level, it's very difficult to anticipate when prices will slide, for how long and how far. And so you have to kind of like um, zoom out from this question and do two things. One, look at your personal situation and say, is now the right time for me to get into real estate, regardless of what a couple of different scenarios and how things go, right? So ways you can evaluate that is, do you have cash reserves? Do you have an emergency fund in place? Do you have stable income or other income streams that would bolster some tough times with your real estate portfolio? Do you have access to lines of credit? That could be credit cards, that could be zero interest credit cards, that could be HELOCs, that could be friends and family money, whatever that looks like for you. And do you have skills? I think there's probably other questions to ask there, but it's really about looking at your situation and then couple that with a long-term view. So hopefully anyone that works with me understands that it's important to look at real estate as a multi-decade type of decision. Now, if the opportunity presents itself in a year or five to sell and cash in on some big equity and make another move, great. But the reality is that shouldn't really be plan A. Plan A should be buy and hold for the long term and experience the tax benefits, the principal pay down, the long-term appreciation, and the cash flow, right? So and then couple that. I think the last piece to this is, if you are interested in perhaps becoming a serial real estate investor and someone that can kind of free yourself from your day job or your spouse's day job by investing in multiple properties, looking at investing in real estate, kind of like a lot of people look at investing in stocks. It's not trying to time the stock market, but just dollar cost averaging, or investing a little bit every paycheck or every day. And then take that same principle and apply it to real estate. Buy a property every quarter or every half or every year, for 10 years. And chances are some of those were bad timing, but others were great timing. And in the long run, 10, 20, 30 years, none of it will really matter whether you bought it, um, you know, 10% before a slide, or at a price premium, because in the long run you'll be coming out ahead. So that's how I think about timing the market. And hopefully you've got those principles in mind, and then you're also running a scenario analysis for every property and understanding kind of the risks and the potential downsides, but the upside as well. And just remember that inaction and sitting on the sidelines for years at a time also has consequences and costs involved. So it's not just the risk of taking the action, but also the risk of not taking the action that should be taken into the equation.